Did you know that a whopping 90% of your investment returns are determined by asset allocation, not stock picking? That's right, your portfolio success hinges more on how you spread your money across different asset classes than on which individual stocks you choose. Mind blowing, isn't it? Welcome to the game changing world of smart asset allocation. It's the secret sauce that separates the investing pros from the amateurs. Today, we're diving deep into why mastering this skill is absolutely crucial for your financial future and how it can turbocharge your investment performance like never before. That's right, today I'll take you to Smart Asset Allocation, what you must know. If you're new to the channel, hit that subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. Let's get real for a second. Most investors are making some serious blunders when it comes to asset allocation, and it's costing them big time. First up, we've got the all eggs in one basket crowd. These folks are so hyped about a single asset class, maybe it's crypto, tech stocks, or real estate, and they just go all in, leaving their portfolio dangerously exposed. Then there's the set it and forget it gang. They think asset allocation is a one and done deal. Newsflash, markets change, and your allocation needs to evolve too. Don't even get me started on the follow the herd investors. They're constantly chasing the latest hot trend, leading to a portfolio that's more chaotic than a toddler's playroom. And let's not forget about analysis paralysis. These people are so overwhelmed by options that they end up doing nothing, missing out on potential gains. These missteps can seriously mess with your portfolio's performance. We're talking increased volatility, missed opportunities, and worst of all, falling short of your financial goals. It's like trying to win a marathon in flip-flops. You're setting yourself up for failure before you even start. So we're about to embark on a wild ride through the asset class jungle. It's like choosing your weapon for a financial battle royale. And trust me, you want to be armed to the teeth. Let's start with the heavyweight champion of the investing world, stocks. These bad boys are like the friend who's always up for an adventure. They can take you on thrilling rides to the peak of Profit Mountain, but watch out. That might also drag you down into the valley of losses. Stocks represent ownership in companies, and they're perfect for those looking for long-term growth. Think of them as planting seeds in your money garden. Sure, there might be some storms along the way, but with patience and the right conditions, you could end up with a mighty oak of wealth. Now let's talk about bonds, the introverted cousin of stocks. If stocks are the life of the party, bonds are the responsible friend who makes sure everyone gets home safely. They're loans you can make to governments or corporations, and in return, you get regular interest payments. Bonds are like the comfort food of your portfolio. They might not be exciting, but they'll keep you satisfied when times get tough. They're perfect for balancing out the wild mood swings of your stock investments. Next up, we've got real estate, the asset class that literally keeps a roof over your head. Investing in property is like playing Monopoly, but with real money and actual tenants who might just call you at 2 a.m. because their toilet is clogged. Real estate can provide both steady income through rent and long-term appreciation. It's like having a golden goose that lays eggs or rent, and it gets more valuable over time. Just remember, unlike your monopoly properties, you can't just pick these up and put them in your pocket. Now, how about let's spice things up with some alternative investments? We're talking commodities, private equity, hedge funds. These are the exotic spices of your investment curry. These can add some serious flavor to your portfolio, but use them sparingly. They're like ghost peppers. A little goes a long way, but too much might leave you in financial agony. So, how do we mix these ingredients into a gourmet investment meal? That's where strategic asset allocation comes in. It's like being a master chef, but instead of balancing flavors, you're balancing risk and return. First, you need to know your risk tolerance. Are you a bungee jumping adrenaline junkie, or do you break out in a cold sweat when you lose a game of tic tac toe? Your risk tolerance will determine how much of your portfolio you allocate to riskier assets like stocks versus safer options like bonds. Next, consider your investment goals. Are you saving for a down payment on a house in 5 years? Or are you planning for a retirement that's decades away? Your time horizon plays a crucial role in how you allocate your assets. It's like planning a road trip. If you're going cross country, you'll pack differently than if you're just heading to the next town. Now, let's talk about some specific allocation strategies. If you're young and have a high risk tolerance, you might go for a more aggressive allocation. We're talking about 80% or more in stocks, with the rest split between bonds and alternative investments. It's like ordering your rare steak. There's a higher risk, but potentially more reward. On the other hand, if you're closer to retirement or have a lower risk tolerance, you might opt for a more conservative approach. This could mean 40% in stocks, 40% in bonds, and 20% in real estate or other alternatives. It's like ordering your steak well done. Not as exciting, but you know what you're getting. But here's the kicker. Your asset allocation isn't a set it and forget it deal. It's more like tending to a garden than building a house. You need to regularly rebalance your portfolio to maintain your desired allocation. Market movements can throw your carefully planned percentages out of whack faster than you can say bull market. For example, let's say you start with a 60-40 split between stocks and bonds. After a year of stellar stock performance, your portfolio might have shifted to 70-30. Rebalancing means selling some of your stocks and buying more bonds to get back to your target allocation. It's like being the responsible friend at a party, making sure no one asset class gets too rowdy. If you're not convinced, take a look at this fascinating tidbit. A study by Dalbar Inc. found that from 1990 to 2010, the S&P 500 returned an average of 9.14% annually. But the average equity fund investor only earned 3.83%. Why? Poor asset allocation and trying to time the market. It's like having a map of buried treasure, but deciding to just wander around randomly instead. One more pro tip. Consider tax efficiency in your asset allocation. It's like playing a game of financial Tetris, fitting your investments into the right accounts to minimize your tax bill. For example, you might want to hold tax-inefficient investments like bonds or REITs in tax-advantage accounts like IRAs, while keeping your long-term stock holdings in taxable accounts to take advantage of lower capital gain rates. Remember, asset allocation is about finding the right balance for you. It's not about chasing the highest returns or avoiding all risk. It's about creating a portfolio that lets you sleep at night while still reaching your financial goals. It's like finding the perfect workout routine. It's challenging enough to see results, but not so hard that you give up after a week. Since you've made it this far into the video, how about I unveil the holy trinity of smart asset allocation? These are the secret ingredients that will turn your portfolio from a bland financial soup into a gourmet wealth-building feast. First up, diversification. It's the don't put all of your eggs in one basket of investing. Spread your money across different asset classes, sectors, or even geographic regions. It's like being a financial octopus with tentacles in many pots. One arm takes a hit, the others keep you afloat. Next, we've got rebalancing, the art of keeping your portfolio in check. It's like giving your investments a regular haircut. Trim the overgrown parts or sell high and nurture the underdeveloped areas, which is buy low. This systematic approach keeps your risk in check and can even boost your returns. And last but not least, maintain a long-term perspective. Investing is a marathon, not a sprint. Don't let short-term market hiccups throw you off course. It's basically like planting a tree. You don't just dig it up every day to check the roots. Give your investments time to grow and compound. Master these principles, and you'll be well on your way to becoming an asset allocation ninja. your future self will thank you. So basically, smart asset allocation isn't just financial jargon. It's your ticket to reaching your money goals and building a rock solid financial future. By strategically spreading your investments and staying the course, you're setting yourself up for long term success. It's the difference between hoping for wealth and planning for it. Also, here's a brain teaser to get the comments flowing. If you had to choose only 3 asset classes to invest in for the next decade, what would they be and why? Let's see those crystal balls in action. Well, that's basically smart asset allocation. What you must know. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.